All right, good morning, everybody. Let's start this party, huh? It's March 11th. I think it's a Wednesday already, huh? March 11th, 2015. This is your daily Forex strategy session. My name is Wayne McDonald. I'm the Chief Market Strategist for Foreign Exchange at tradersway.com. Right now, we're looking at the S&P 500 futures up a little bit. Even though the market hasn't opened, it's the futures market. It's up a little bit after a pretty tough day for equity trading. Yesterday, the Dow was down like at one point like 3%. I think closed down, what, 2%? So 300 points. I mean, pretty bad day. But I wouldn't get that too confused, especially when you're talking about an index like the S&P 500. The reason for that is if the market is anticipating, or more importantly, preparing for interest rate changes at the Fed, then institutional portfolio managers just simply need to rebalance their positions based on this new information. We're in an efficient market, so if they're saying, well, we expect the Fed to raise interest rates in the next 6 months, some stocks will benefit from that, some will not benefit. Let's just say the American companies that export products, well, their products are becoming more and more and more expensive. And they'll be less competitive, less profitable, so on and so forth. So you might want to scale back on those equities. But others are going to win from the stronger dollar, for example, as a consequence of the central banking change. So anyways, a big drop doesn't scare me yet. First of all, we predicted it, a week ago. Remember the S&P 500? We had it all lined up anyways. So anyways, so some rebalancing and stuff. I think it'll fall for a while, then it'll go right back up. All right, it's not an economic crisis. It's a portfolio rebalancing. And, you know, not really far from the end of the quarter either. Doesn't seem shocking to me, so don't freak out, huh? All right, so anyways, so S&P 500 futures up 1/3% today. NASI way down 1.42%. So tech stocks are really in tough shape. Yield on the 10-year T-note, 2.13. And you're like, what does that mean? Put it in a context. Well, at the end of the Fed taper, it was 3.0. And then it dropped to 1.8. Oh my gosh. I used to think before the end of the before the financial crisis, I thought the end of capitalism was when the 10-year T-note dropped below 2%. In fact, I debated that the 10-year T-note couldn't drop below 2%. My argument was if the 10-year T-note dropped below 2%, then yields on like the 30-day would have to go negative. And the world doesn't function with negative yields, right? Or you get what happens to the euro, which has negative yields, and look what's happening to the euro these days. So anyways, 10-year T-note at 2.13, you know, it's sitting on the precipice of death, you know, but it's above 2.0. It should be, what? If the Fed hadn't been manipulating things, it should be probably 3.2, not 2.2, you know? So we're a full percentage up. So I'd like to see that to start going up soon, right? Oil, 48.48. All right, fine. It's not 20 and it's not 60. So we're just hovering around the psychological level of 50. USD yen up a little bit, 1/3%. Euro USD down over 1% today. I mean, look, the ECB is finally doing quantitative easing. So for the last 3 days, it's weakened. Not a shocker. At least it shouldn't be, right? And what is the net result, or not net result? Well, what is a consequence of quantitative easing? Asset prices go up. In particular, equities, right? Check it out. What the CAC up 1.84%. The DAX up 1.72%. The FTSE, 0.14. So let's see. France up almost 2%. Germany up almost 2%. The UK, no change. Do you think any of that has to do with the euro? Oh, yeah. Oh, yeah. So anyways, very quickly, British pound strong, euro weak, Swissy weak, yen strong, dollar strong, Aussie strong, CAD strong, Kiwi strong. So really, it's just euro so weak, it makes everything else look strong in comparison. So it's messing up my indices. But let's go through some technical analysis, huh? Let's get going. Remember, trading and investing, in particular with leverage, is ultra risky and not appropriate for everyone. However, your past performance, even if it's not that good or if it's not that bad, doesn't predict future results. Every day is a new day. So always stay small, stay humble, focus on the long term, and never risk money you cannot afford to lose. All right, so we thought this green zone on USD yen was plausibly or possibly based on I don't know, a dozen different things. Could possibly be a buy zone. This was 24 hours ago. So there's an order in the green zone here, just above 121. And it's moving along. We're up, what, 32 pips or something, $300 floating. All right. Does that seem reasonable? Oh, you don't see the screen. What the? Do you see anything? Do you see the business card? Oh, now it's on. Oh, okay. Some people see it, some people don't. Okay, good. All right, so that's all we discussed yesterday on this USD yen. Back out a little bit here, and you see where we are in the process. We talked about it. There was, remember I said create a fundamental or long-term technical bias. So that's your strategy. If you're a bull in this case, identify 3 levels in which you would like to buy, because if you're a bull, all you do is buy. And where do you buy? High or do you buy low? No, you buy low at support. So identify 3 levels of support. Okay? 1, 2, 3 levels identified yesterday. And so I purchased at the first level. And here we are, just moving along. Does everybody understand? Now, I know it took me, probably 20 minutes to discuss this with you about creating a long-term bias and dropping down into ways to, all the way down to the trigger, right? That's what we did yesterday. Talk about building a trade plan. Start with a strategy, drop down to smaller trends to do technical analysis, look for a trigger. Okay? Now, how long should this take you if you've already developed a strategy? The strategy being you're a bull or a bear for a logical, intelligent reason that you could, let's say, prove on paper. Okay, Mike still haven't. There's Mike. I mean, right? What's the problem, Mike? Right? We said we were a bear on the Japanese yen, bull on the dollar. We were going to buy. We identified 3 areas in which we would look to buy, and then we would drop in and do small technical analysis. Now, Izzy asks a very tough question. As far as the risk management, so you can see you have a stop loss in the market, right? When do you move your stop to break even? Well, that depends on a lot of different things. Am I a scalper? Am I spot? Am I swing? You know, and that, so it's a judgment call based on what you're trying to do. It's a judgment call on your confidence. It's a judgment call on the technical analysis. Okay, so I could certainly move it to break even now if I wanted to, or I could certainly move it closer, right? Below the lowest low. All right, so then, Mike, I guess you'll have to show up tomorrow, right? You're not an expert yet, huh? We'll get you there, Mikey. But let's not worry about individual trades. I mean, look, as a currency trader, you'll make a million trades, right? What is important here is you developed a strategy, and we have three areas where we can consider entering a trade in the direction of that strategy. None of them have to be entries. They're just zones where you might do something, and the only thing you can do is buy. So your entry technique, to me, isn't really that important either. I think on the long run, if you do your analysis and you identify areas in which a bull would buy, I think you'll be just fine, especially if you give yourself enough of a stop so that you can stay in the trade. Okay? Versus entering way late, like if you were buying now at 121.50, to me, it's too late. You're like 50 pips late. You're buying at resistance. Now, there's a couple of reasons it's resistance. Let me zoom in here. Come on, MT4. Okay. One, it's the midpoint psych level, right? Okay, but two, if you were a bear, where would you sell? This is very important as a currency. You always have to set up the other trade, right? The trade that the bears are going to take in this case. If you were a bear, where would you sell? $1.22, okay, so that's a double top. You're waiting a very long time. You're not very bearish. YJ says sell now. Well, don't tell me now. Tell me why. Well, there's no guessing, Mike. Double top's very late. If the market's so bearish, then why would they wait for 100% retracement to sell? You actually need the bulls to get out at that point. So that's not really bearish yet. 618 Fibonacci retracement. Thank you. Okay. 618. That's where a bear would, a reasonably confident bear would sell there. Looking at this, and they're thinking lower high. Because why? Because they're a bear. Okay, and they have it. Okay. So I don't like. So if you notice my charts, this is such an important thing for me to identify the fib levels. Watch this. When I move my fib, you'll see that they're already drawn there. This gray line is the 618 Fibonacci retracement. So if I was a bear, I would want to sell here. In fact, my sweet spot for selling, think of it like right of the center of the club head face on your golf clubs. The sweet spot is the 382 to 618 fib retracement. If I'm a bear, I'm going to sell there. Okay. That's why you can't be that late, right? So this is why we've identified a green zone to buy. And when you buy, you should be somewhere next, because buying up here is just a very, very, very bad idea. And clearly you don't have a trade plan, right? You need to buy low, not buy low and then wait, 8 hours or 9 hours and then buy it high right at the midpoint psych level and right where a bear would sell. Okay? So let's say price came down one more time. What am I going to lose here? 25 pips? Where would my stop be if I bought here? Probably the same place. But what do I lose now? 75 pips. You see the difference? That's going to be a tough business to be in, right? Entering late and then widening your stop. The only difference is having a better entry, because your stop's probably going to be in the same place, underneath the lowest, the nearest lowest low, right? Okay, so that's that. What happens if it comes down now and makes a lower low? What happens in that case? Well, it takes a small loss, and I may back away and not consider buying some of these down here anymore, my green zone, because I might play this now like a head and shoulders pattern, right? And I measure the distance from the top to the neckline, put it to the breakout point, and project down. Okay, so I might have to skip a couple of the intermediate buy zones and re-identify new buy zones, which would be closer to 1950, 1950 versus, and I'd skip all this stuff because I'd want the head and shoulders pattern to play out. Right, you guys follow me on that? Okay, which is important because when do you change your opinion, right? I mean, it seems easy, but isn't that the ultimate question? I mean, that's the most difficult thing to be doing in the live market, right? When do you go from neutral? And I think it's the key to success down the road after you become pretty decent as a trader. When do you tell yourself to stop doing the strategy that's been successful? Right? You might do the same type of trade 3 times in a row and you profit, and the fourth one you do it again, the same thing for the fourth time, and you lose money. Okay? But that might cost you 30 or 40% of your day's profit. And you end up working more hours and only to throw away 30 or 40% of your profit because you made 3 good trades in a row. You tried it one more time, but it was one too many times, right? So how about this? You buy this dip and that doesn't work, so you lose money. And then you buy this dip and that doesn't work, so you lose money. And then you buy this dip and that does, all of a sudden you're just buying a falling market. Obviously, that's not something that you want to be doing, right? So when do you stop? Well, I think it's okay when you make a higher high, higher low, predicts, right? And the next higher high, higher low, fine, higher high, whoa, pretty big pullback. If this produces a lower low, Do I need to remain generally bullish on this pair at the moment? No. It's a good time to say, whoa, 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 whoa. Okay, but now, if we make a 3A2 from the top to the, or let's say a 50% or a 618 off the top, let's say it does about a 50% and then does this. Okay, it makes a new higher high here, right? Let's say this is about 50%, maybe a 618 of the bigger range, right? Then it makes a 1, 2, 3 the other way. Now I could be a bull again. Is that too complicated? Okay. That's the fractal nature of the market. We can talk about that, but let's move on, huh? Another one we discussed is the pound dollar. Psychological level of 150. Let's get rid of this. Okay. This area was going to be an issue. That's the daily chart. And have we made any lows yet? No, it seems to be consolidating right where we thought. Okay. You shouldn't be too frustrated that it's not falling or rising. I mean, look where we are. Okay, that's a daily chart. We said, and I'll remind you, but we've said over the last couple of days, this could move sideways. The British pound versus the dollar could move sideways for a month. Okay? So it shouldn't be a shock, right? There we go, right? This is the hourly chart now. Does that look like a good opportunity for trading? No, not really. Right? So I'll sit and wait on this one. But what's the general rule of thumb? If I want to buy the British pound, am I going to buy the pound dollar? Help me string together the pearls here. No, I think if I wake up in the morning and I look at the market and I want to sell the British pound, I sell the pound dollar. If I wake up in the morning and I want to buy the pound, probably buy the pound yen, right? Thank you, Armin. Oops. Did I close the trade? Oh, dang it, I clicked the wrong thing while I'm coaching. Hate that. I closed that yen trade. I was trying to close the terminal. Oh, dang it. So anyways. Shoot. Hate that. What was I doing besides crying? Yeah, pound yen. Kind of like Gordon Gekko, right? Oh well, so only make 20 million. All right, so that's a 5-minute chart. I guess we got to back out a little bit. Okay, and we're right in the middle of our range. Looks like we almost hit that prediction a few weeks ago. Look at that. Look what you could even see what we were talking about. Bottom, top, retracement predicts a top here. We got pretty close. Now we're consolidating. Okay, we're in this range now. Oscillator not quite, in the low zone. But what is this telling us, this cross currently? It's telling us that price was falling, but these candles in the near term have stopped making lower lows. That's all it's telling us. Okay. The reason, well, this goes to the same logic that we had on the buy USD yen trade that I placed yesterday. Same logic here that we had before. Okay. Higher high. Right? How do you set up the 1, 2, 3? Find the previous lower low, which we've done with the green zone. Right? So that's where we are now. You take this tail, and it's the potential entry. And it predicts this move here. The higher high predicts the higher low, and plausibly continuation pattern. Okay? Again, go from a high here to a high here. That's what sets up this. Okay? So it's not really working, but it's not working. Right? And so that was yesterday's trade plan as well. That's a 4-hour chart. Okay? So your entry, here or here. Right? London Open. If you were a bull. In the short term, it looks just rangy to me. Oh, what are the Stokes settings? 853 or 835 is how it's written. Okay. So I like to speed up stochastics because it represents overbought and oversold conditions for price. And then when I use MACD, I slow MACD down. So that shows me overbought and oversold conditions for the market. Okay? And ideally, you line up price action with market forces. So if you say the market is bearish, ideally you're selling, right? And you're selling price action. It's amazing when I work with traders that are in a rut, I find inevitably that they're buying in a falling market and selling in a rising market, and they're just doing everything backwards. Okay. If you were bear on this, where would you sell? You would sell off the lower high. Okay. So we're in fib wars here. That's why you want to buy low and we'll give it work out. If it drops like this, probably want to exit for a loss and maybe consider buying it down here. Okay? If it works out, obviously, it's going to basically 1, 2, 3 this way. Work its way up at least to the red zone, hopefully higher. Okay? You could obviously hedge now. If you were in a position, you could hedge with your binary. What do you guys think? Up or down on this one? I don't really care. I think the odds are pretty close to 50-50 anyways. Hourly chart says down, doesn't it? But that's why they invented stop losses. But what do you guys... Well, what if you were a portfolio manager with $1 billion? Do you think you would be net long? I mean, if you have $1 billion, you're not day trading, right? You're building positions. You're building a portfolio. Japanese yen, what do you think? Would you be in the business of buying Japanese yen or in the business of selling Japanese yen? And I'm talking yen, not yen pairs, just the yen. If you had to sit down and discuss it with your core clients, the strategy over the next 18 months for the Japanese yen, what would you tell them? Oh, I don't like to trade with this strategy. I don't like to commit to a strategy. Kind of like to wing it every day, just kind of make it up and go, go, go. Right? All right. Okay, good. So what if, though, you looked at this and said, you think it's going to fall? You're already essentially net short the Japanese yen. That means yen strength. So what do? What would a hedge fund manager do in a scenario like that? Talk to me, Goose. You hedge. I try to give you a... What would a hedge fund manager do? They might hedge. All right, so let's pretend now we're portfolio managers. Okay. Let me just change the size of this a little bit. Oh, no. Okay. You'll see up here my Traders Way MT4 account 38136. My binary account 38136. OMG. So this binary account is attached to my MT4 account. In fact, let's do it this way. To illustrate, there's the chart we just set up. Let's pretend we're worried about it dropping. In the center chart, this is pound yen again on a 1 minute. Let me change this from pound yen cash to pound yen binary option. Boop. There we go. I'll move it to a 5-minute chart. Okay, all good, right? It's all the same, right? Only the names will change every day. Okay, so let's hedge now. You're a hedge fund manager, you have a large portfolio, you happen to be short Japanese yen, but you look at that and say, ooh, I think there's a high probability it's going to fall over the next 8, 9, 10, 12 hours. I don't want to take the risk of losing money. I want to ensure my long-term position. Your insurance policy here is a binary option. You think it's going to fall, right? So what do you want to do? Okay. Now, ideally, you see how we're at 82.84? Wouldn't it have been better to have acted, let's say, at 183.00? Because you're trading binary, does that mean you should be sloppy with your trade entries and with your technical analysis? What do you think? No, of course not. What's interesting with trading is that if you're long pound yen in the cash market, the spot interbanking, Forex market, you have unlimited upside. Okay? And as you might have found with a Swiss franc recently, there's also unlimited downside, right? Now with the binary, it's all fixed, so you don't even need risk management because you either win or lose, and the win is already preset. The loss is already preset. So that's why a portfolio manager would use options to hedge a cash position. You're long the cash. Now let's short the derivative to hedge the cash. And it's like just a little insurance policy. So for $250, I might be able to insure this for a few hours. You get it? So if you're worried about it, and like this is what I was saying earlier, you should anticipate. If you're a bull, you need to buy at support when it's oversold. That's what bulls do. And once you're in, when the issue now is trade management and risk management, you need to identify where the bears are going to act. And now you know where you could do things like hedge or scalp. How could you possibly scalp if you don't know where the bulls and bears are going to buy or sell? Right? Otherwise, you're just like guessing, swinging both ways like a broken gate, changing your trade with the change of the wind. I'm a bull, I'm a bear, I'm a bull. Oh, well, if it ain't going down, I guess it's got to go up. Right? That kind of nonsense, right? Yeah, like Mike. Right? So, you still need proper entry, proper risk management. You still need patience and discipline. But that's how you would hedge. Okay? Now look at here. If I threw down $250, well, let's change it and make the math easier for everybody. Okay? So if I threw down $180, I'd get an right? No. If I put down $100, I would, if I'm right in this hedge, if it does go down a little bit, they're going to pay me $180. If I'm wrong, I lose my $100. But that's the cost of insurance. Why would I be wrong? Because it went up, but I'm long in the cash market. Well, why is that a better deal? Well, because I have unlimited upside. Pound yen could go up for 5 years and I go on it. Plus, I earn interest. So this is just a cheap little insurance policy, right? To hedge my long-term portfolio position. Nice. This is why portfolio managers think differently. Like I said with the S&P 500. Hey, the S&P 500 came down a couple of percent. Yeah, but it's not the end of the world. It's probably just rebalancing of portfolios. They'll just get out of the ones that are the equities are likely to lose in the new scenario and move the money to the ones that are likely to benefit from the new scenario. The new scenario being interest rates up in the next 6 months. Cool, easy, right? So like you say, risk-reward ratio, less than 1-to-1. Well, let's say you did a 25-25 OCO. That's a 1-to-1, correct? Wrong. because you have to account for your spread. So look at that as accounting for your spread and your cost, right? An ECN, you would have spread and the commission on the trade, right? So you still have your cost. So it's the same in that case, identically the same, I believe, as trading a Forex position. But fixed, a fixed stop loss, a fixed limit order. You can't screw this up and blow out your trade account on your $100 position, right? Because it's all fixed. So it's set it and forget it type thing. Now, you can manage a binary option. You can get out early and all that kind of stuff for a smaller win or a smaller loss. So that's nice. Right? But how right or how wrong do you need to be? Well, this is why I think binaries are also good for scalping. So let's say you sold, let's take Mike's trade in. Mike sells it up here in the red zone. And it's a scalp. But a scalp you can be in for 2 hours if you want. What if you did it with the cash market, you sold for 2 hours, and it just kind of did this? You'd make hardly anything. But you still had your cost, you still had to stare at it for 2 hours, and it just didn't go anywhere, consolidated, and you're like, that was terrible. Well, what if you did binary and you did that? You'd get paid for the whole amount. So using like a 25-25 OCO scenario, you might only be, let's say, 5 pips right, but you paid for the full 25. That's why with binaries or any trade that you make, you need to buy and sell at support and resistance. Otherwise, you're just a fool. Mama don't raise no fools, right? Or mama gonna knock you out, fool. So anyways, it doesn't allow for sloppiness. Okay? So just for fun, oscillator coming down, 5A cross. We tested a psych level and failed. Come on. So let's throw this sucker down. Okay. And look at the binary chart. Check that out. Let me clear some of that out. You see it? Now, clearly, with the 5-minute oscillator, it tells me I could have waited for it to come up. It's probably going to go up for a while. But I just want to get that in there and show you. So that's the binary. This one, I didn't even pay attention when it expires. At the stock market open, right? Oh, no, it expires in 10 minutes. So the bottom of our hour, all right? Now, you can adjust this. Let's say you wanted it, more time. I'm usually like a 45-minute kind of binary guy. Okay, but anyways, that's how you could possibly do it. Pick your time, and you say, in this case, at 9 a.m. New York time, I think pound yen will be lower than 84. Right? 183.84. That's it. Done. Oh yeah, everything changes a little bit, right? The future value and all that kind of stuff. But let's let's take a look at it. End of day, okay, still pays 80%. Okay. So not a bad deal. Remember that builds in your cost of making the trade and stuff too, right? So again, if you were an ECN, you'd be paid 1-to-1 minus your trade commission minus spread. So essentially the same thing. Okay. Another way you can do this is like, right. So you can change these time frames and stuff like that. But it's still hardcore technical analysis should still be the right thing to do. So in this scenario now, as a portfolio manager, you're buying your green zones and then hedging in the red zones. Okay. Yeah, okay, good. Naya wants to talk about Kiwi. Are they going to lower interest rates? Let me address Ron's question since it's directly related to what I was just discussing. Let's say I changed my mind. Right? Here's my position, pound yen. I sold at 182.84. Right? Expires not far. So, you know, what do I do now if I change my mind? Get out of this position and lose 80 bucks. Right? I put 100 bucks on that. Okay, so I put 100 bucks on it, right? If I change my mind and I want to get out right now, they would pay me $22.30. But I paid 100 bucks. But I didn't lose 100 bucks, right? If I change my mind for whatever reason. And the same thing, let's say I have a 4-hour binary, but 2 hours into it, I'm already quite profitable, but I doubt it's going to go any farther. Like now, I just would rather just take my money and run now. So you can go in there and let's say I put in 100 and I could make 180 at the end of expiration. If it expired right now, I'd get 180. I could check this out, and if it said, well, we'll pay you 170 to get out right now, and you're like, you know what, good enough. Give me my 170. I'd just like to be out. So you can still do trade management. You just can't lose more money than you put in. And you can't make more money than the potential payout. So, but that's built-in risk management, right? Where do traders tend to lose money? It's not necessarily the losses. Now, okay, let's say you're a bad trader. You just lose money. Okay, fine. Let's talk about someone that is pretty reasonable. Why are a lot of traders losing a little bit of money or basically break even? Is it because their entries are poor? Because their technical analysis is bad? No, it's none of those. You know what I have found it to be? Over and over and over again? Trade management. No, trade management. Okay? A reasonable trader doesn't have these big devastating losing days where they blow up their trade account. They're past that. But what's happening is they don't let their winners run. right? They get out of their trades too early. They might have a lot of break-even trades as well. Why? They're so obsessed with losing money that as soon as they have 13 pips, they jam their stop at break-even. No, and then what happens? They break even. But that trade was worth 250 pips. Okay, it's risk management. So long story short, traders end up hurting themselves because they get out of their losers, which is great, but they also get out of their winners, and their winners never win. So all you do is set yourself up inevitably for failure, right? Because then what do? Then you're like, well, I'm going to widen my stop and open this up and not manage my trading at all, and then boom, now they never win and they only have bigger losses, and then it's all gone. So in this case with binary, you don't need to worry about that because it's all built in. You're not going to over manage your trade. It's a set it and forget it scenario. Okay? Much better place to sell, right? You know what? I wish I had done it up here. Okay? Let's try it this time. Oh, just wait. I want to double check the time. When will it expire? At the end of the day? It gives me lots of time, right? All right. We're right at the psych level. Oh, come on. I always forget that part. Oops. Boom, 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 boom. Okay, so lots going on. That would be a way to hedge it. Sure, let's talk Kiwi. So Yen or Jen is asking a question about, but you bought in the green zone, the buy zone. Yeah, we're talking about hedging. So I'm long cash and short the derivative to protect my cash position. It's a hedge. We're talking about hedging. Okay. All right. Let's talk about the price action. Okay. Bottom near 70. Very significant rise. Drop into a buy zone. Okay, consolidates, make a higher high. This is a new green zone. Comes down, tests it, great. Makes a new higher high, new green zone. Comes down, double tops. Uh-oh. You see this circle, guys? This was our trade plan for selling. Follow the horizontal line down, and we were overbought. Okay, let's go back. That's this one. Hang on. We set this up with a sell on an oscillator rollover on the daily chart in our sell zone now. Even though we had shorter term price action up, as I just shown you, the whole time we had it set as a trade plan for a lower low, lower high, lower low. Okay. First challenge of drop is going to be the bottom. Okay. But this is a 618 Fibonacci retracement. What's the projection? You guys tell me, what's the projection? Yeah, 1382. And the projection is 69, which we've talked about 5 times, I think we've gone over this trade plan, right? Sell it at 76. Take profit around 769. Armin says, why can't we hedge entering in a cash trade in the opposite direction? You certainly can, right? That would be cash on cash. Okay, but now both positions have unlimited downsides against each other. They also, one's making interest, one you have to pay interest on. You also have to have management of both. Okay? Versus using a derivative. Remember, options were created to hedge positions. That's what they do. So you're just taking a derivative and buying a short-term insurance policy on your long-term cash position, right? And again, I think the Forex side is a million times. Again, I could be long pound yen for 5 years, still be in the trade, making pips, plus earning interest on the yield, on the carry. And it doesn't sound like much on one position, but what if you had 45 or 50 positions? Every single trade's at break even, so you have no risk. You have 100% available margin on your trading account. But you're making a lot of money. Could be thousands of dollars a day in interest, especially back in the day when a Kiwi yen was paying 8%. Okay, so you don't want to sell the cash because now you got an 8% carry against you. Now you have to pay 8% interest on that Kiwi yen short to hedge your Kiwi yen long. Well, that's kind of like kills the whole point. Remember, we're in an unusual time with yields around the world being ZIRP, zero interest policies, ZIRP. But traditionally, these derivatives were created so that you could hedge your cash position. So that's why you'd want to be long the cash and short the derivative, short the option, short the binary. Okay? So anyways, guys, if you shorted at 76 and you're at 72.50, okay, this is just one of the, I think we had 3 or 4 or 5 trades where I set you up with over 300 pips per trade. Okay? Moving averages, 5-8. That's the red-black one. That's for entry. 2155 represents the market. $200 is the fair market value, okay? So here's the fair market value on the 1 hour chart for the Kiwi dollar. The 2155, in particular the spread, the angle and separation between the two, that's the market forces. So this is when the Kiwi dollar became bearish, in my humble opinion, right there. The market, as I describe it, is bearish starting there and is still bearish. But in fact, the angle and separation generally has been good. So I'm bearish and aggressively bearish. So when do I sell? When price is bearish. Now we know even though the market can be down, price could be rising in a down market. What I want to do is sell in a falling market. So I sell when the 5 crosses below the 8, 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 so on and so forth. Okay? Now, one of the things I tend to do is I use the oscillator, qualify the opportunity. Okay? Does this look... Okay, now we know the 21 and 55 are falling. The 21's acting as a dynamic level of resistance. And I get a 5-8 crossover indicating price action is down in a falling market. The oscillator is like 90% overbought. Is that a good opportunity? Yes or no? Come on, guys, let's do it. I call the Stokes, in this case, the Stokes or any oscillator, whatever I'm using, I call it the kicker. The last card, right, to be dealt. Is it a good kicker or is it a bad kicker? Is it a king or is it a 3? Right? Changes everything. Okay, fine, good. Get to the next 5-8 cross. 21 is below the 55. 21's in charge. 5 drops below the 8. Also 90% overbought. In a falling market, is that a good opportunity to sell? 21's below the 55, 21's in control, 5-8 crosses down, oscillators at 50%. Is it a good opportunity to sell? Lousy trade. 21's in control, 5 drops below the 8 in a bearish market. Oscillators at 50%. Is it a good opportunity to sell? Mediocre at best, but basically not. Has there been any buying opportunities? No. Should you be worried about this going up? No. Is the downtrend slowing? Yes. What's likely the next thing to happen? It comes up, hits the 55, and then drops, and then maybe retests the 55, and then consolidates, and then breaks out, which is not today. Oscillator settings, 835. Everything's exponential except the 8. It's simple, but it shouldn't be relevant. Doesn't matter. You can use whatever you want. Seriously. Use 72. Use 3472 for your market. Doesn't matter. Long term for value, medium term for market, short term for a trigger. Honestly, does not matter. Pick anything, it'll work. Why would it work under any scenario? Because all I want you to do, Captain Obvious, is tell me you're a bear. Somewhere make a decision, Mike. And then act upon that decision. If you're a bear, sell. I don't care how you come up with it. Sell in a falling market. You'll be fine. Right? Don't worry about, oh, I don't have my chart set up properly. I don't have the right moving average. It doesn't matter. These are the ones that work fine for me. Let's change them. Right? Let's use 20 simple moving average. Oops. Okay. Let's use 50 simple moving average. Let's use 100 simple moving average. Okay, good. Oh, well, that changes everything. Forget about it, right? Oh, no. Now it's completely different. Oh, come on. Sell it for crying out loud. Right? Let's not make it too confusing. Make a decision. I'm a bear here. Well, notice that when you finally get the crossover, price is here, right? So selling low is an idea, isn't it? Good. Wait for a retracement. Sell on retracement. Good. A lower low. Great. Now what do you want to do? Sell now? No, it's oversold. Wait for it to be overbought. Comes back into your sell zone. Good. Sell it. Now what is it doing? It's just slowing down. Okay. Are they good opportunities to sell? No, you should have sold when it was overbought. But the bottom line is, make a decision and then do it. And that's what we've been talking about like last several days. What's your strategy? Are you selling the kiwi or buying it? Well, I don't know. Well, then don't trade it. What's your strategy with USD yen? Are you going to buy it or are you going to sell it? Oh, I want to buy it. Good. Give me 3 levels of support in which you're interested in buying it. Those zones, drop into a smaller time frame, and use technical analysis to pull the trigger while you're still at support. Moving average crossover, oscillator crossover, reversal pattern, do something intelligent, right? In this case, it's on a 5-minute chart, not a 4-hour chart. You see? That's why everything, even if you're a scalper, it's imperative that you have a strategy. Are you a bull or a bear? Okay? And if you're a bull, I only want to see you buying, and I only want to see you buying at support. And if you're losing money, I bet you, 1, you probably don't have a strategy. 2, you're buying and selling. And 3, you're buying way too early or way too late, and you're selling way too early and way too late. Why do I know that? Because you don't have a plan. How could you possibly be able to pick proper areas to buy and sell? There's no way. So you're either way too early, but the funny thing is if you're early on a bullish trade, you're just late on a bearish trade. And you're mediocre, you're probably doing both very poorly. You see what I mean? So if you flipped a coin and that day you're a bull just out of random dumb luck, at least you know that you can only buy, and you can only buy at support. So now you identify support and resistance, right? And in this case, support, and you can only buy. So when you get there, you're buying at support. Your trades are going to be way better than they are now, simply because you're buying at support. Even if you're wrong, you're going to be better off. You see? Peace on earth. May the pips be with you. May your profits be above average. Thank you for being clients of Traders Way. I'm going to upload this video immediately to youtube.com/C youtube.com/Traders Way. So if you miss a video, you can always go there and get it. It's also available on traders.com. Thank you for being on my team. Got to jump, babe.